So I see participants coming into the room. We'll wait for a minute and then we'll begin. Okay, let's jump in. We have a very exciting conversation today. Thank you, everyone, for joining. So, as we all know, there has been a whirlwind of activity and change in the realm of financial regulation and supervision in the past 2 months, from CFPB to OCC to FDIC. A lot of moving pieces. At the same time, the day-to-day on the ground doesn't stop, and everyone in the space still has to continue to go on about their business. We're here with some top experts in the field to discuss what changes are taking place, what we might expect in the future, and how to deal with all of the volatility that's happening right now. I'm honored to present our spectacular panel today. So Raj Date, managing partner of Fenway Summer and a former special advisor and former deputy director of the CFPB. Phil Goldfurter, CEO of American FinTech Council, and Laurel Ramon, partner and FinTech co-chair of Jenner & Block. We're going to be having a conversation for quite a while, but if you have any questions, please drop it into the chat and we'll do our best to get to it. So let's start with the CFPB, since obviously so far it has gone through the most changes, from director to funding to functionality. Can you share a little bit of your perspective on what is happening at the agency and what do you think the future holds for it, near future and long term? And maybe Raj, if we could start with you.
Yeah, I think I had the wisdom not to prepare a lot in advance for our conversation today, knowing full well that things would change hour by hour. And so what would be the point? And there's going to be a lot of that, actually, that same sensibility of like, what in the world is going on and what's going to happen, next week. And a lot of that chaos, I suspect, is, if not straight up intentional, is a not especially regretted side effect of that which is being undertaken by the administration. So there's some very clear things that are for sure going to happen and continue to happen. So there were a number, the things you can be very, very confident about is that practically anything that got done between the election and the dismissal of Rohit Chopra as director of the CFPB, through just sort of fiat or just kind of independent action of the CFPB without a notice and comment rulemaking, like all of that is going away. And to the extent it hasn't already, it will. I mean, that would be sort of the default assumption you should use. Second, even things that did get done through a so-called, Administrative Procedures Act rulemaking is, and indeed right now, you can see, susceptible to being unwound through something called the Congressional Review Act, whereby Congress basically says, you know what, like this agency was delegated authority by the people to do X, Y, and Z. We don't like how the agency did X, Y, and Z. So now that goes away. And in fact, the agency can't do any more rulemaking in that area going forward, which is quite a striking thing and imminently foreseeable, which raises some question marks as to why one would have been acting with such alacrity to do things, knowing that this was a hazard. And then there are some things that that are important in the grand scheme of things in the consumer finance markets, that it's not totally clear what will happen. So, for example, what will be the degree and detail and depth of supervisory activities with respect to both the depository institutions, so those above $10 billion in assets that are organically within the CFPB's supervisory jurisdiction, as well as all of the non-banks that are also within the CFPB supervisory jurisdiction. How much supervision per se will be getting done? I mean, the notion of supervising entities there's quite a bit of latitude in terms of what it is that might mean. And the difference, as anyone who has been on the receiving end of a supervisory exam knows, the difference between something that is relatively lackadaisical and quite draconian is something that makes a big difference to an institution, its people, its practices, its interactions with customers, not just now, but into the future. And then you also have the question of like, what about the CFPB as an institution? You know, like how is it that it is going to be able to over time retain, attract people? I'm getting a little bit of feedback on my line, which I'm sure is me, but it's probably a sign that I should stop talking. But there are some very important questions longer term about both the impact that the agency will have, as well as its functioning as a high quality institution in and unto itself. I do not envy future leaders of the Bureau. It is a lot. Listen, it was hard to build something. It's very easy to tear something down, but I think the hardest thing of all is to rebuild something. And so I do not envy that challenge for whoever ends up with it.
So firstly, let me just thank you, Anna and Spring Labs, for bringing us together. I'm humbled to be sitting here with Laurel and Raj, and I don't deserve the right to talk, and so I'm going to keep it to a minimum. But it's funny, normally I'm the one who kind of sits at the macro level. Raj, a lot smarter than me, kind of really dives in. I think Raj really focused on the pragmatic, what is happening today. I kind of want to take it sort of a step up to 20,000 feet, which I think a lot of us were thinking about maybe early on, in that, is the agency going to exist? What's going to happen? You know, people are being laid off. There was a 24-hour period where there was, in theory, 3 different leaders, right? You know, Bessent was the interim, and then it was Vogt, and then literally the next day, Jonathan McKernan was nominated to serve, and it was sort of like this. You're exactly right. Like, you can't prepare, because in the course of my speech at 5 p.m., by the next morning, it had already sort of shifted. My talking points had already shifted. I think it's important to recognize that regardless of, I think everything that Raj said is exactly right. But regardless of all of that, from the American FinTech Council's perspective, you need regulation one way or another, right? You need rules of the road. You need to understand what the parameters to work within, so that you can build a company and sort of emerging industries in the right way, so that you're no longer susceptible to the political whims sort of every 2 years or 4 years. And so I think it's critically important that the agency continue to exist. And I can't say that emphatically enough, even though I catch some flack for that, right? Like, there are some people who don't necessarily agree with me on that. But I think it's critically important as an industry association, we lean into regulation, because ultimately in financial services, regulatory structure is, you know, enables us the foundation to build for the future. And so I was encouraged, and again, sort of through the shifts, even now, right, with sort of Vogt sort of serving as interim director, we're sort of leaning into what needs to happen and how it needs to happen. And we were encouraged by the nomination of Jonathan McKernan. We think, again, we think he's a reasonable, pragmatic regulator who has a history of working with industry to craft reasonable and pragmatic regulatory structures. So also, the nomination to me signals that we're going to have an agency, regardless of some of the noise that still is out there, even though he was nominated and you're still hearing some of the noise. I think that we don't know how big it's going to be and sort of what their processes are going to be, but the fact that it is somebody like that, who I don't think comes to it with a tear it down mentality versus what is a reasonable approach to regulating financial services.
Great.
So I'll
Thank you,
jump
Phil.
in.
Laura?
Yeah, just add, you know, Phil and Raj have taken it up a level. I'm going to take it down a level, which is to talk a little bit about, you know, I don't think we can overstate the impact to the people who work at the Bureau and what it's going to mean. And this is very different from the prior Trump administration, where I was always, so I worked in the Bureau in the early days, you know, before the Trump administration, knew a lot of the folks. Those folks have all still been there, many of them, which always surprised me, how long they stayed and sort of how dedicated they were. That's a very different situation than what we're talking about today. I'm literally on the phone every single day with current or former CFPBers who are trying to figure out where to go now, whether they currently have a job or not. So the loss, and granted, that's more in enforcement, given that that's my background, but I think that's true across the board because the uncertainty is there. So, you know, I think we all think it will exist in some form, statutorily required to exist, but the personnel, the people with the historical knowledge, the people who do the work, it's a dramatic change there. And so what can be done is a big question. But at the same time, in terms of where are we going to see the impacts of the CFPB's work to date and sort of its planned work, what we do know is the CFPB, anticipated something, maybe not what we're seeing today, but they were, preparing information and issuing guides to the states on leaning forward on some of the same activities the Bureau was already doing, how to codify things into state law, how to bring, UDAP cases, not that the states didn't already know how to do that, but, to sort of transfer the knowledge and goals of the Bureau to other players. And so that groundwork has been laid. So I think we will see that being picked up even outside of the Bureau. But in terms of the Bureau's ability, just from a pure staffing point, it's going to be a very different environment going forward, no matter what it looks like.
Let me just pick up, Laurel, on something you just said, not because it's 100% salient to most of our audience today, but because I cannot resist. If you were to look and level of criticism at the demography of the federal kind of bureaucracy, broadly speaking, I think you would look at it and say, this is like not a normal bell-shaped distribution of people in people's tenures. You don't really see that, and you just walk around the FDIC or something. I can assure you, you're going to see sort of a bimodal distribution where you've got a lot of people who look sort of like me, like they look like one lap away from retirement kind of thing, and a bunch of people who give the distinct impression that they don't quite know what they're doing yet. That's a very hard way to run a professional services organization, which at the end of the day is what every regulatory agency is. And this haphazard approach to cost cutting that's going on is going to result in making that so much worse. Because as it turns out, the people who can't afford to have a bunch of like chaotic nonsense going on are people who are at the prime of their careers. The people who are one lap away from retirement, whatever, you'll stick it out. It's fine. And, in this economy that I fear that we're about to have, the people at the start of their careers don't have a ton of other options that they would in a normal environment anyway. So I think we're going to make this problem worse, which as, someone who spent a decent amount of my youth caring about these issues in this institution is very painful for me. But that is the path that we're on.
Got it. Got it. Thank you. Thank you, everyone. What do you think of what do you think the CFPB has changed course a little bit on some of the cases that they're going forward with, the cases that are dropping, right? So they're dropping Capital One, TransUnion, Rocket Homes, if I understand correctly, but they're letting some other cases move forward. What do you make of that, if anything? Like, I don't know if there was necessarily a sort of a rhyme or reason behind the ordering there. I'm assuming there is. Any thoughts?
Dare I comment on that? I'm not sure I have a comment. I think there's, again, we still don't know what we don't know in terms of who's sort of pulling which strings and who's making determinations. I also want to say, and if I can provide a little bit of a counterbalance to what Raj said, I don't think he's wrong. I think he's right, fundamentally. But I think it's a little bit unfair to kind of look at what this administration is doing and not recognizing that they're responding to something. Now, I'm not putting that all on the CFPB, and I'm not, sort of making the point that sort of any one agency deserves sort of any sort of, I don't want to say retribution is not the right word, but sort of the flip back, right? We say this all the time, there's a pendulum, right? And we should, in financial services regulation, you should not have a pendulum ever, right? It should be what is in the best interest of the ecosystem, of the industry, of the integrity of the financial system in order to protect consumers, period. That should be the case regardless who's sitting in the White House and regardless of who's leading the agency. And so it would be, you can't look at the situation today and say, I can't believe what's happening, and not look at some of the reasons why it's happening and some of the decisions that were made that maybe led to some of the feelings of why people are making. And I'm reminded of that every single day. I mean, today, the American FinTech Council, we have over 130 members, and I'm reminded, and sort of they come from all aspects and all walks of life from all across the country with political, ideological viewpoints. And I'm reminded all the time sort of what, sort of why people are thinking the way they are on both sides of this issue. And so I kind of look at it as, again, sort of from 5,000 feet looking down, saying, I recognize sort of why some people are, sort of why actions are being taken, whether I agree with all of them or not. Is not necessarily important or not. And I still think that we still just don't know yet enough about sort of who is pulling the strings, why things are happening the way they are, what ultimately it's going to look like. But I think it's important to recognize that we are just seeing this shift. And by the way, if everything remains as it is today and the continued uncertainty, God knows if we could live like this for 3 years and 10 months. But like, if it does, you're going and there is a flip next year, in 4 years, you're going to see the flip back the other way, right? Like, and so if we don't come to some sort of equilibrium of sound financial regulation and create clarity, two things are going to happen. Number one, industries will not grow and emerging industries will not serve consumers. Number two is consumers will be less protected, and unfortunately, nefarious actors are going to have, sort of take advantage of that. And number three, you just, there's never going to be any certainty.
Yeah, and I'll just add,
Phil, go ahead.
Oh, go ahead.
I was just gonna say, Phil, I've never received such a high compliment as he's not totally unfair. So that's
I think he said you're not totally wrong.
Oh, that's
Maybe,
even better.
A little bit right.
It's my special day. Yeah, I will just say, and Laurel, don't forget what you're about to say, is that I think it is a nice lesson to remember for today's and future leaders of government agencies. Like, we live in a democracy, right? So to the extent that you care about the long-term institutional credibility of the agency with which you are charged, you had, I don't know, probably want to be viewed as sort of a fair actor, as somebody who is listening, even if one is disagreeing. And if something borderline existential is going to be posed, it would be nice if the most important people in the entire industry, which is kind of an important industry, kind of felt obliged to pick up the phone and try to stop it. And that didn't happen here. And I think it's a nice reminder. Laurel, I apologize for interrupting.
No, not at all. I couldn't agree with you more. And also, and with Phil, to the point of, I don't think we know, getting back to Anna's question of what do we think is happening with enforcement now? I mean, I don't think we know yet what the strategy is. I mean, a lot of the talk coming out of the administration across financial regulatory issues is we want to ensure room for innovation. We don't want to be stifling innovation. I don't think we can look at what, sort of the dismissals and what's going on with enforcement from the Bureau at this point and say that we're seeing that theme there. Maybe if anything, the theme is they wanted to take it down to zero and basically stop everything, which they did, and then slowly have sort of picked up a couple places where they're going to proceed. If we look back to the first Trump administration, we did see enforcement action ongoing. It was a little bit different from what was before and what was after. I mean, some of the sort of, kind of more egregious frauds, certain sectors of financial activity that were, sort of maybe, considered some of the more base elements of financial services, around payday lending and, debt consolidation and things like that there was still activity, as opposed to sort of larger financial institutions focus on recidivism or novel products and that sort of thing. So I mean, maybe that will be a guide to what we're going to see again. We don't really know. I mean, it doesn't seem that principled, other than we just want to stop the CFPB right now. But I mean, obviously we'll be watching it closely. And I go back again to, again, the sort of staffing and sort of where are the people going, and you're seeing them pop up in pretty active places around state financial regulators. And so, you just may see a shift of some of those cases.
I think now I'm going to choose my words much more carefully now, Raj. We've all served in government. Again, in different capacities, we've all served. And I think when you're in government, you're charged with a responsibility not to, you no longer get to be an advocate. You get to have your own political opinions and ideals, but government has to function, and you have to be there to ensure consumers are protected and you're not stifling, innovative growth and company growth. There is a certain part of that where you have to find ways to compromise. I'm not going to talk about the last week because I don't want to go down that rabbit hole in terms of, compromising and how that's all played out. But I think it's some of the lessons that we've learned from the election, if there are any, and there's a lot, is that you've got to find a way to compromise to keep government functioning. I would, in criminal justice and in financial services regulation, right? And probably 10 other ways where government has to function regardless of your political ideology. I'll shift for a moment just to the FDIC and look at the last month where acting chairman Travis Hill has sort of already taken 3 actions that we had been asking for the better part of the last 2 years, and you've already seen sort of a seismic shift, which I don't think have an ideological bent. I think are just rational sort of things to do. And so number one was removed the amicus brief that the FDIC filed in Colorado, which the amicus that the FDIC filed last year sort of reversed 100 years of precedent from initially the FDIC. And so I think restoring kind of the precedent. Number two was sending a letter to FinCEN to modernize and encourage them to modernize CIP. Again, something that we've been in a rational way been asking for quite a long time, and to see him take that action and sort of let FinCEN know that you can safely modernize CIP rules. And then third is sort of withdraw, I think, a lot of what the fintech industry saw as an assault on broker deposits with the last proposal the FDIC put out. And so seeing sort of acting chairman Hill kind of take those 3 actions, to me, is a pragmatic sign that we could take positive steps to support innovation, which will not in any way, shape, or form stifle or put consumers in any more harm.
Yeah. And before, Anna, you drag us grudgingly away from the CFPB topic altogether, I will point out the irony, right, is that, I know Jonathan McKernan, as I feel like most people in Washington, he is a sober, sensible, pretty predictable guy. And I think if you look at people who've been both past directors and acting directors of the Bureau, the person who most fits the mold of a conservative, kind of small c, kind of financial services policy person from inside the Beltway. Like, he's probably the least of the wild card that we've had, including, by the way, me. And so that to me is another sort of ironic aspect of what feels quite chaotic right now.
Great. Well, Phil, you mentioned FDIC and Travis Hill, and I guess to shift to that a little bit, right? Same question that we had with CFPB. What do you think is in the cards for FDIC and OCC? And specifically, Travis Hill talked about bank charters for fintechs and other things, and you mentioned a couple of other things that he's already done. So, what do you think what do you think is in the future, and do you think there's room there's opportunity for fintechs, for example?
Absolutely. I spoke about this a lot right after the election. Sort of the shift in government is not it's not a signal for free for all to change what you've been doing and your regulatory approach and your compliance approach and your consumer protection approach when you're in fintech. The change, to me, signaled pragmatic opportunity to have real conversations. And I would argue, and I think Raj would agree, sort of the way he just described Jonathan McKernan, you sort of put the same sort of attributions to Travis Hill. He's a thoughtful, smart leader who I think is willing to engage industry and be very honest about what industry is doing right and the fintech industry is doing right and where they're making mistakes. I think when Yellen McWilliams took over at the FDIC with 2017, it was not she came with a very balanced approach. And I met with her a number of times. She likes to say that I used to stalk her at conferences, but I met with her a number of times, and we had real conversations about real challenges that we had with her predecessors. And there was never not even one time did she ever say, well, don't worry about that, you can do what you want, ever, right? She was very focused on, let me understand what the challenges were. Let me understand sort of what you offer as a solution. and let me be the arbiter to determine sort of what is the right regulatory approach moving forward. And to me, I think that Travis Hill embodies some of that same spirit in terms of recognizing sort of the pragmatic approach it takes to regulating emerging industries. This is not about what industry wants. It's about what consumers are demanding. I want to be clear about that, because I think oftentimes the consumers get lost in a lot of these conversations where my kids don't know what the inside of a bank branch looks like, right? And they have investment accounts and they have 6 different apps in which they tell me when my father gives them a $100 bill, they tell me in which apps they want to put it in, right? Because they don't even know what to do with a $100 bill. And so at the end of the day, the fintech ecosystem, the responsible fintech ecosystem, is serving those consumers. But that doesn't mean they can, just because a consumer wants it, it's sort of free for all. Like I said, there's got to be a right balanced approach. And I think the current sort of roster of nominees, sort of, to me, right, and obviously we're gonna go through this process, meet the qualifications that are necessary, not to tear down agencies or throw away rules that are working, but to think about new ones that need to be created for emerging industries that are serving consumers.
Yeah, I mean, my perspective too, I agree with you, Phil. I mean, but I think we're talking about a sea change. I mean, in terms of what this means practically, in recent years, the financial regulators, we're very concerned about, obviously, sort of novel products, that being the term that was used, and broad adoption across consumers very fast, which is and has always been one of the challenges of the new sort of digital economy and new digital products, is that you can be up and running with thousands or hundreds of thousands of users in months, or a year, and be holding or dealing with people's money very, very quickly. But I mean, this is really it's going to be significant, because in the past there's been sort of an unwillingness to either approve new products, or even now we hear regulators talking about, well, we still are going to care about the same core regulatory issues we've always cared about. That's going to be safety and soundness, AML compliance, these types of things. But the lens is going to be different, because, in recent years, safety and soundness, sort of fundamental issues, you couldn't even get past that issue, because the idea of, say, dealing with a crypto company or holding crypto operational accounts or other types of fintech accounts was considered such a risk to the safety and soundness fundamentally, without much further discussion or exploration. Whereas now, at least, what we're hearing and seeing is that that's not going to be sort of the default skepticism about safety and soundness risk. I mean, just to say that I think that we are going to see a very significant change in terms of what is possible, what products are possible to sort of get off the ground. And then the issues of, AML compliance, regulatory compliance, safety and soundness are going to still be very much issues, but they're going to be a little messier, because what that looks like once you're in business, where you have a company that's new, and any new company building a new financial regulatory compliance system, it's a very big challenge. And so that's going to be a little messier, sort of figuring out what the regulators think is a true risk to, say, safety and soundness.
Yeah, I think that the prudential regulators as a group probably have a series of relatively straightforward dials to make slightly more forward leaning in terms of innovation, a little bit more assertive in terms of the perimeter of what can belong in a regulated bank. All of which it's pretty easy to sit down and kind of list out like what would be in a sensible near-term agenda. I think the harder thing that will at least be possible, and that I would encourage them to embrace, is to rethink the nature of supervision itself at banks. For anyone who has been around a bank, and I've been around many, the reality is that the bank supervisory process has very much become a process, very focused on policies, procedures, very kind of mechanistic views on how things are decided, as opposed to substantive risks themselves. There is no better example of this than the Fed's own postmortem on SVB's demise, Silicon Valley Bank had many a so-called matter requiring immediate attention, none of which had anything to do with the interest rate risk that ultimately blew up the bank. And so it's not by virtue of a lack of attentiveness to process and procedures. Quite the opposite. It's too much attention to procedural things and not enough attention to substance. And that is not a great recipe for success. And as a special added bonus, it adds a ton of energy and cost in what otherwise is dead weight loss to the economy. And so that's a hard problem to tackle, but frankly, McKernan and Hill and now Bowman have at least a plausible opportunity to try to tackle it, knowing full well that, like most bold things that matter, it will probably fail. But if you don't try now, I don't know how you get there.
Yeah, if I can steal Anna's role of asking questions here for a second, Rod.
Yeah.
I mean,
please go ahead.
I could not agree with you more. And we see that, when I'm working with companies on a day-to-day basis, the requests come in, the conversations happen. And I have friends who are examiners. I respect the role. It's challenging. It's really important work. And I've been impressed at the sort of ability to learn and grow with new technologies that I've seen. But at the same time, what you describe is absolutely the case. It's very much a check the box exercise, and so companies have to build their compliance programs to that, which is not necessarily, and sometimes not at all, aimed at actual successful, efficient compliance. And so on a very practical level, Raj, especially because you've been in a leadership role at the Bureau, I mean, what do you see as sort of a near-term ability to get examiners, even if the administration's view is like, okay, we really want to change how this is happening? How does that turn over? And how do you make a real difference in what that experience is for companies that are being examined?
Yeah, I mean, it's a good question. And of course, I don't know the answer, but I do have the answer of, like, if it were me, which it most decidedly is not, like, what would I do? And I would grapple with this by essentially picking, let's say in the case of the CFPB, but frankly, this would be way more effective at the FDIC or the OCC or the Fed, picking 10 institutions and say, you know what, this exam cycle, we're going to undertake to do this with 80% fewer people and try to get it done from first day letter to final report out in 80% less time. And let's find a way to do it, full stop. And it will be a train wreck, right? Like, it'll be, bad, I can assure you. But unless you try to do that, you're never going to get to something that's that's twice as fast and twice as cheap. There's just no way to do it. By the way, this isn't like, I'm not like inventing, this is how you would do it if it were your own money. This is what you would do if you had an experience like running a big company. I often say to people that, like, to, younger executives at our companies, that you don't want to do it, but everybody should go through the pain of a big cost reduction exercise. Like, most people hate it, but you'll learn something. And I think what we're seeing right now through all things Doge is what happens when you have a bunch of kids who've never done it before, just kind of like throwing stuff at the wall. That's not how you do it. What you do is you kind of create a constrained, cauterized thing to try something radically different, learn, and then iterate from there.
I'll just pile on because I agree with everything you both just said. I think to what you said earlier, Raj, it's much harder to build something than it is to tear something down, right? And so I think what you just said is exactly right. Let's try it a different way. Let's throw something at the wall and in a contained space so it's controllable and we're managing. I'll sort of bring it back to the consumer again. When the challenges that you both mentioned are very, very real. And we think about it too often times from the company's perspective, right? A big fintech company that's serving millions of consumers, or a bank that is powering, 5 companies or 5 fintech companies responsibly serving millions of consumers. You're taking resources away from their ability to actually operate those relationships the right way. And you're draining their ability to do that the right way. And if they're responsible, they'll scale back because they can't manage it, right? And so they'll scale back. And ultimately, the consumer is the one that loses. And so I think too often and government is probably is probably most guilty of this. We kind of get into our cycles. Okay, this is just the way it's always been done. And unfortunately, you've seen a lot of that over the last number of years with the examination. I mean, I talk to my banks nearly on a daily basis who are struggling. Even now, by the way, somebody just said to me this morning, the same examiner that was in my bank a year ago is the same guy who's back today. And regardless who won the election, he hasn't changed, right? Like he is the same guy looking at our issues or looking at our operational compliance mechanisms the exact same way. And so if we don't make the system shift, right, then it's not going to shift. I think the question then becomes, okay, so how do you do that? And that's probably where people will disagree. As long as we're thinking about it in a pragmatic way, and I think the leaders of our, sort of the current slate of leadership that is soon to be hopefully taking over some of these agencies are going to be the type of people who will do that and create, look, a good example is sort of the FDIC, literally tore down sort of the innovation office, the FDI tech that was set up previously. And instead of reinvesting that into education and innovation within the FDIC, they kind of reallocated that money completely out and destroyed it. I'm optimistic that we're going to put more money into some of the innovation offices. I think what the Fed did with the Novel Activity Supervisory Program was great, right? Did it work perfectly and is it all settled? No. But you've created opportunities where people who weren't necessarily sort of didn't have the ability to touch innovation or some of these activities were now learning about it and understanding it and doing a deep dive. And so huge kudos to the Fed and the OCC as well. The OCC has had an innovation office for a long time. I would, again, dare I say, they were one of the first to have an innovation office and for years met to understand sort of the evolving nature of the innovative offering. And so I think we need to reinvest in that, and I'm hopeful I'm hopeful that we're moving in that direction, even though right now it's hard to maybe see.
I think that's a great point. Like absent some top-down leadership, and those are good examples of it, right? Like these things wouldn't have just, or the Fed's novel activity wouldn't have just organically sprouted up. But it actually takes some top-down wisdom and initiative. Because you're absolutely right that there are structural things about the regulatory agencies that are inherent to what they do, and they are not going away. So, for example, there's a fundamental risk asymmetry, right? If you're an examiner in charge of like a mid-sized bank, if the bank thrives and does great work, nobody throws you a parade. But if the bank fails, I can assure you people notice. So it's a crazily asymmetric, and that's just reality. You're not going to magically solve that. In the same way that, like one great benefit that we have in the private sector is you have the crucible of a profit motive to burn away stuff that doesn't make any sense. Like I don't do a lot of stuff that doesn't make any sense at all because it doesn't pay the staff, right? Like there's a crucible that really is very helpful, and that's not how the government works, and you should be glad that that's not how the government works. But that means that it puts even more of a premium on having a vision, a strategy, an intermediate set of goals, and some near-term urgency by leadership.
And I guess the thought I would add to that, and it sounds like we're trending optimistic right now, which I haven't. It's sort of outside my normal in these weeks. But to add to that, I mean, I am hopeful. I mean, there's been a real sort of cabining of innovation and compliance because of the risk and guidance. Guidance that's been out there from the prudential regulators and others. Saying, sure, you can try new things, but essentially you have to do it parallel to all the old things. And we'll decide later whether it's okay and whether it worked, but we still want to see all the old things, which makes it, to your point, Raj, like not cost effective, not efficient in any way, and not a lot of incentive to do it. And so, along the lines of what Spring Labs does and other companies that are looking for efficiencies and providing new ways of doing compliance, I think that this approach should allow for more attempts at that, which could again be a sea change. I mean, and of course, companies are looking to do compliance with fewer people. I mean, I talk a lot about staffing. I mean, doing it with the right people in the right places is critical, and you can't understaff. But there are a lot of ways to leverage, the new technologies, and those are really table stakes for fintech companies you have to do it that way. And there's been a real skepticism on the regulators' part about using those technologies or relying on them. And in large part, they don't understand them. And to some extent, that's because, you know, the companies that I've seen may not do a very good job of articulating what these products do and how they're really integrated and supplemental to the actual thinking around risks and policies and procedures that really also matter. But with that openness, I hope that we will see what we all want, which is actually more effective compliance, you know, at a more efficient pace. And I do think there will be a more room for that as we go forward.
Interesting. Thanks, Laurel. So it does sound like you're treading optimistic on the innovation portion, at least, right? So I guess everybody on the ground is trying to figure out what all of this means to them, right? Because you still have to go to work, you have to do your job. So do you think we are in an era of lighter touch, of lighter regulatory touch, or do you think it's a little bit of musical chairs? Other regulators will step up. Some regulators get weaker, some regulators get stronger, maybe states get a lot more active?
I I love that question. I
Oh.
just saw a head. Yeah. Oh, sorry.
No, go ahead. No, I was just calling it.
Yeah, I love that question. I just saw a headline, and Raj, I'm sure you saw this, and I didn't actually read the article yet because I was traveling, but is the CFPB heading north? And then it was announcement of new CFPB staff that was going to work at the Department of Financial Services. There's been sort of talk with the Attorney General's office. I mean, former Director Chopra just did an event with the Attorney General of New York last week, sort of expanding, introducing legislation to expand New York's ability, the Attorney General of New York, to go after, sort of certain bad actors in certain instances. And so what I have said post-election, I think still holds true, is that the second we allow the perception of deregulation to permeate, we are going to face the number one, confusion about what is the rule, what isn't the rule, what should we be doing, what shouldn't we be doing. And number two, states from across the country are going to step up, whether it's banking regulators, attorneys general, are going to step up to try and fill the perceived void. And so from my perspective, it needs to be business as usual, and an increased level of engagement. I think the biggest challenge, and I know we talked a lot about the CFPB, and I'll compliment what compliment is due. I mean, where in so many areas I disagreed with Director Chopra, he was always available. I mean, there was literally not a time that we reached out or asked him to come to something and participate in something that he did not participate. And I don't say that lightly, and I ask a lot. For all of you who know me, we ask for a lot, and he responded every time, right? And if he didn't, he had a good excuse for not. So we don't always agree, but I think that engagement is critically important. Unfortunately, not everybody over the last few years has been that willing to engage. And so I think that the answer now is we need to engage, and we need to ensure that the perception of deregulation doesn't continue to spread, and that we're looking at ways to build responsible regulatory parameters to ensure that we're creating a foundation, as we said earlier, so we start to avoid the pendulum swing as we move forward. And so I do think that again, the perception of deregulation is out there. I think we need to pull it back and ensure that everybody in the industry is not thinking about deregulation, but more importantly, thinking about what are best practices, what are the standards. I'll give a plug to Seema Gandhi and the work that they're doing at CFES to create standards within embedded finance. We just announced that we've become strategic partners on their advisory board. We're excited about creating a standard. It's not a free-for-all, right? Fintech needs to be regulated. Embedded finance needs to be regulated. Innovative banks need to be regulated. They just need to be regulated the right way.
Yeah, to add to that, I mean, I agree with you, Phil. I'm really, really happy for organizations like AFC that are kind of helping with those standards. And you look at certain states like New York, is obviously, California and others that have already been sort of ramping up in this area, over the last few years. So they may ramp up more, but it's not like it's coming out of the blue. They already were very engaged, as well as a number of other states, including, developing additional, laws and regulations and guidance, specific to consumer protection and a lot of other aspects around sort of newer financial services and products. And what's interesting is I have had some conversations with clients recently, about, well, maybe we don't need to be in New York. Maybe it's better if, we've got an OCC charter and that's open where it wasn't before, and those sorts of things. So there is a little bit of that kind of wondering about maybe, there's a way to sort of leverage these new opportunities that it seems the new administration is bringing. But I do think it's going to level out on some level, and people want to be where the markets are, and so states like New York and California are always going to be there, and do tend to sort of set standards that apply across the country, and the states are sort of moving that way. But it's interesting to have some of those conversations right now. But I think the takeaway is, as you said, I mean, you're going to pay in the end, whether it's, in customer satisfaction, customer volume, potential enforcement when the pendulum swings later, but maintaining some consistent approach across these sort of tumultuous years is certainly going to be the most efficient way to go.
Yeah, I mean, the great irony is that I'll paint with a broad brush, right? Certainly would not include you, Phil, but I think the industry, broadly speaking, post Dodd-Frank, has successfully waged a campaign of hyperbole that has the real potential to taking the most important roles in American consumer, especially consumer finance regulation, and handing them to the attorneys general and bank superintendents or their analogs in California and New York. Because, if you want to build like an internet scale business, like realistically, in the English speaking world, you kind of can't not be in California, like realistically. You can not be in Indiana. And so like it's a bunch of states that are not themselves not sufficiently large that end up suffering. And the other thing that ends up suffering is that you end up layering on more and more complexity and compliance burden, which makes it very hard to operate a small firm. I mean, if it was so wonderful and easy to start a bank, we'd all do it, I suppose. You know what the return on equity of banks in the US is right now? By the way, like unemployment super low, like things are pretty good. ROE for the banking sector, I bet you, is something that rounds to 12%. Like, I'm in the venture capital business. I can assure you that, an investment that doubles, if you're lucky, in 6 years is not something that feels like a great idea. And adding still more kind of fixed cost burden to those kind of enterprises seems ridiculous. Now, I've always been, and I mean, my office is a block from the White House, so maybe, of course, I think this way, but I am an unapologetic fan of the idea of national preemption on things that are national markets. And I think you end up with better results and a more vibrant set of competitive enterprises and lower costs for people and small businesses and commercial enterprises. And until I see some actual math to suggest that isn't the truth, I'm going to continue to bang that drum.
Yeah, I mean, maybe I see a question came in that may flow from what you're saying, Raj. Anna, do you want me to on the complaints question?
I am not sure. You talking about the payday lending room question?
No,
I
there was
think
a question about
the
how to
Q&A.
handle
Okay.
complaints.
Oh, yes.
Yeah.
Which sorry.
Yeah,
Okay. Let me jump to the I think it's going in the direction of complaints, but that's let's chat about that, right? I guess what would be your advice to day compliance professionals about what they should be doing, what should they be expecting? Like, for example, a lot of the compliances with CFPB is formulating around responding to complaints, right? Making sure that process is correct, make sure that you're thorough. And that, do you still respond to the CFPB complaints? How do you think about ongoing examinations and investigations, right? I guess in these two categories, like how would a day-to-day professional think about, first of all, the complaints? Do you think about that in the sense that, continue responding to CFPB complaints as you were doing before and expect that the process will continue or maybe shift in some way? And how do you think about upcoming examinations?
I mean, I can jump in on the complaints question to start. I mean, I think the answer is yes. I mean, we don't know how the Bureau is going to handle complaints going forward. You know, there's obviously been consternation and pullback and then restaffing. And so we don't know exactly, but we do know that lots of people have access to the complaints on the Bureau's website. That the complaint, you know, the general idea that complaints serve as an early warning system for all kinds of issues still holds true. So I always think of that as being a very, very rich data set regardless. And you know, civil litigation is probably going to, you know, rise in the absence of the Bureau handling some of these cases, class actions and other things. So I think it would be unwise to not be aware of what complaints might be in the portal about your institution and respond to them the way that you normally would. There was a question about sort of how you handle complaints issues across jurisdictions, and are we going to see a lot of you know, changes or differences among states? And I think the reality is no, because there's not one, you know, consistent approach in the first place. And it's really about sort of demonstrating that there is an effective complaints handling process that allows you to get ahead of issues in the first place. So, I mean, I think the process will change given that we don't know, you know, sort of administratively how the Bureau is going to be handling these things, but in terms of substantively thinking about complaints and do they matter and should you respond? I think the answer is, you know, an unequivocal yes. And I will just throw in terms of, you know, sort of ongoing investigations in particular, you know, you know, as someone who deals with that every day, I'm not going to suggest that anyone, you know, spend money or time developing a formal response to an investigation that may be suspended. But I would take a moment to understand what the issues are and think about whether they pose a risk, regardless of whether the Bureau is actively investigating or not, and whether there's a risk that some other agency may, or again, there may be a class action or other things, and use that time to try to shore up, you know, whatever issue may need some improvement, and think about it that way. And that probably holds true for examinations as well.
Yeah, I think you mentioned something there, Laurel, that I just want to underscore, which is the notion of complaint volume and the nature of complaints being a little bit of a divining rod to the customer experience, broadly speaking, and kind of an early warning system on what ultimately is kind of franchise value and net promoter scores. And while I know Spring Labs and some other firms are harnessing technology now to be able to make that more effective. So even away from kind of the government complaint handling, I think there's a vast reservoir of still underutilized data associated with, you know, complaints that I think are going to take you know, kind of a couple of things to really kind of actualize. One is the use of better technology. Thank you, Anna. A second is the focusing, especially where like complaints are likely to be the best divining rod, and I can like I credit like firms like Chime and like that somehow are able to make a living on very tiny little transaction accounts. It's sort of amazing, but when you serve small dollar balances either on either side of the balance sheet, you're going to have way more complaints. Like I've never seen an example to the contrary, for pretty natural reasons. And so that's where you have to be especially attentive. And then finally, I think just culturally, both within firms as well as in regulatory agencies, I think it's sort of useful to remember denominators, right? If I have a million customers and I have 12 things that go very wrong, like that's 12 very bad things, but it does not necessarily mean that you have miscreants running the business. And I think that when government agencies go out of their way to vilify people that they know are not some kind of evil tyrants, they know it. When they go out of their way to vilify people, the natural reaction is to stop serving underserved customers. Like, what do you think is going to be the reaction? And so I hope that we can all together kind of embrace that.
I have nothing to say, but I love that. That's exactly right. I mean, it's all about context and perspective and understanding who you're dealing with and who you're talking about. And this goes back to what we talked about earlier in terms of, are we trying to check a box? Are we trying to fundamentally understand, you know, who they're serving and how they're trying to serve them, and then understand sort of the nature of the processes and if there are real challenges there that need to be corrected. You saw, I thought, over the last couple of years, obviously a number of consent orders on innovative banks, and there was a few of them who kind of stood up and said, "Great, this is going to make us strong. We now understand where we had some weak points. Whether we agree with everything or not, it's that's okay. But we're going to come out of this much stronger." Again, it goes back to the question of what they, how they should have been regulated. But I think a responsible actor is not going to bury their head in the sand. They're going to take the criticism and they're going to move forward and become stronger because of it.
Right. And just to kind of thank you so much. That this has been the conversation has been amazing. I want to kind of bring up two last things. One of them is because I see two questions about this. So clearly people are curious about small dollar lending rule. So if you have any updates on that. And the second part is just like a closing question of where do you think we'll be in 2 years, right? Overall, and with since we always look back to innovation and technology, where do you think we'll be with AI and innovation in general? So two very different directions, but curious to answer the questions from the chat on the small dollar lending rule and just overall your projections where we'll be in a couple of years.
Laurel, you want to handle small dollar, and then Phil and I can just make stuff up about the other thing.
I was waiting for you guys to answer that.
I would say
I don't.
we just sent a letter. I mean, we recognize a lot of our
Right.
members are concerned, particularly those in the buy now, pay later space, are concerned about sort of getting lumped into the payday rule and the question of when they have to come into compliance. We just wrote a letter and sent it on Friday to acting director vote that sort of included the need for clarification around the payday lending rule in terms of where it's going to go in the future. And so it's obviously concerned specifically for the buy now, pay later industry in terms of whether they need to comply or not. I think some have said, it's not going to survive. But again, absence of clarity, it's hard for companies to make decisions and move forward.
On what things might look like, a couple of years hence. Two things. One is in financial services, actually, we have been, there are notable counterexamples, this Doge phenomenon, et cetera. But for the most part, we have been pretty lucky in the US anyway, that politics has mostly actually not been in putting a bunch of thumbs on the scales of financial intermediation. We've been mostly lucky. And so a big question, I spent just enough time on Wall Street to believe that humans and firms are driven sort of by fear and greed, and it's just a question of which of them is the dominant thing at that time. And then one thing that's going to be different, even 18 months from now, not even 18 months, 12 months from now, maybe 6 months from now, is that on the Hill in particular, fear about the midterms will be pretty striking and palpable, and it will change the degrees of freedom that Article 2 within our constitutional system has, because Article 1 will suddenly remember that there's a reason why it's Article 1 in our 3 branches of government. And that I think is a big swing factor. My aspiration, my hope, and why it is that I do my day job is that we are on the brink of, through AI and otherwise, technological breakthroughs that could lower the cost of intermediation in the financial system. I owned like 10 cars in a row when I was living in California that were all BMW 3 Series. I just kept buying the same car over and over and over. And it basically was the same price every time, but the car just got better and better and better. And yet, in financial services, the cost of intermediation is still pretty much the same as when I started my career. And that's a crying shame. But at least now, I think you could argue with a straight face that there's a chance that we can make a breakthrough. And earlier I talked about deadweight loss to the economy. This is the opposite. It will lift all boats. And I'm glad that we are all somehow engaged in that enterprise.
Well, it's easy for me. I hope that in 2 years I'll have a BMW. I'm excited for that. Raj hit on a really important point, which I think oftentimes is ignored. We think that, sort of with this administration, there's 4 years. Midterms are. When I got elected in a special election. It was 14 months until my re-election, and I was like, oh my gosh, 14 months. And someone said, yeah, you're already 4 months behind, right? And so you literally, you get maybe 4 to 6 months of trying to govern in a real way, and then 18 months in our current system of getting reelected. And so that's a real thing, which means that we've got what, a year, like reasonably, to like really, sort of figure out what we're going to do in terms of this Congress before you're going to see a shift, right? Everybody's going to shift into political mode and reelection mode, and that changes. It changes everything. It's a game changer, and so I think 2 years is probably too far off. I think we're going to know where we are in a year from now, probably sooner, and what we're going to get done. And then once you know that, you'll know the next step. But I think we'll have a better tell sooner rather than later.
And I'll wind up quickly. I know we're over time. I'll temper my earlier optimism a little bit with what I think will be a real challenge, as I think we will have many more products, and I think that's good. We'll have, through AI, we'll have greater adoption of compliance mechanisms, that we're not used to, and I think that's good. I think we'll have an increase in fraud with the number of players in the system, and that will impact consumers, and that fraud is already a very big challenge in financial crime. And I think that will probably increase, and there will be probably more churn as we have more players, less clear standards. And so the fight against fraud is going to be, I think, increasing over the next couple of years.
Great point. Okay, well, thank you, Raj, Laurel, Phil. Thank you so much. This has been incredible. Thank you for your time. Thank you, everyone who joined, and we hope you enjoyed it. Thank you.
You.
Thanks.
Have a great
Anna.
rest of your day.